Most people do not notice the problem when it begins. They notice it later, after a series of small changes start adding up. The mortgage payment may look exactly the same. The house is still standing. The neighborhood has not changed. On the surface, life appears normal. Then an escrow notice arrives. The monthly payment increases. The annual insurance bill jumps again. And suddenly, a homeowner who believed housing costs were largely predictable finds themselves asking a difficult question. If my mortgage is fixed, why does owning this home keep getting more expensive? For decades, homeownership represented stability for many middle-class Americans. A fixed-rate mortgage offered something rare in personal finance: predictability. You knew what you owed each month, you built equity over time. And eventually, many hoped the home would become one of the safest parts of retirement. But the mortgage was never the entire housing bill. Property taxes can rise, repairs become more expensive, utility costs change, HOA fees can increase. And now, for many households, home insurance is becoming one of the fastest moving costs attached to homeownership. The pressure often starts quietly. Insurance is typically treated as a background expense. It is required. It gets paid through escrow or through an annual bill. Most homeowners think about it only when renewal paperwork arrives. That approach made sense when increases were relatively modest. But recent data suggests something larger is taking place. According to S&P Global Market Intelligence, the national calculated weighted average effective homeowners insurance rate increase was 12.7% in 2023, followed by another 10.4% increase in 2024. This was not a one-year spike. It was a continuation of significant upward pressure. Just as important, the increases were not limited to a handful of well-known high-risk markets. S&P Global found that 33 states experienced double-digit effective rate increases during 2024. Some states recorded increases exceeding 20%, including Nebraska, while Montana, Iowa, Minnesota, Utah, and Washington also experienced increases above that threshold. That matters because many homeowners still view insurance problems as primarily a Florida or California story. The data suggests something broader. This is where the fault line begins. Many homeowners focus on principal and interest. But insurers, lenders, and household budgets operate in a world where the total cost of ownership matters. When insurance premiums rise, the impact often shows up through escrow payments. A homeowner may never refinance, they may never move. Their mortgage rate may never change, yet their monthly housing payment can still increase. The U.S. Census Bureau reported that median monthly owner costs with a mortgage rose from $1,960 in 2023 to $2,035 in 2024. The agency also stated that the increase was primarily driven by higher mortgage costs and insurance fees. That is an important distinction. The issue is not simply that insurance is becoming more expensive. The issue is that insurance is taking up a larger share of the overall housing budget. And for many households, those budgets were already under pressure. To understand why this is happening, it helps to look beyond any single insurance bill. Insurers are responding to multiple pressures at the same time. Higher rebuilding costs can increase claim expenses. Severe storms can create larger losses. Wildfire exposure, hurricane risk, reinsurance costs, and state-level market conditions can all influence how insurers price risk and where they choose to operate. As a result, the impact is not always limited to a premium increase. Some homeowners encounter higher deductibles. Others face stricter underwriting standards. Some receive non-renewal notices. Others discover that their coverage has changed in ways they did not fully expect. What looks manageable on paper can become much more challenging in real life. Because the real risk is not one bill, it is the loss of financial flexibility. When housing costs rise unexpectedly, something else often has to give. For middle-class workers, higher insurance costs can compete with retirement contributions, debt repayment, medical expenses, or everyday living costs. For people over 50, the timing can be especially difficult. These are often the years when households hope to accelerate retirement savings. Instead, more money may be redirected toward maintaining the home they already own. For retirees and near retirees, the challenge can be even greater. A fixed income does not automatically adjust when insurance costs increase. Many retirees are already dealing with rising healthcare costs, utility bills, maintenance expenses, and property taxes. Insurance becomes another pressure point layered on top of existing obligations. The situation becomes even more concerning when financial cushions are limited. Federal Reserve survey data found that 63% of adults said they could cover a $400 emergency expense using cash or its equivalent. That means a significant share of households remain vulnerable to unexpected financial shocks. And insurance-related shocks are often much larger than $400. A higher deductible, a coverage gap, a sudden premium increase. None of these events may seem catastrophic on their own, but together, they can place meaningful strain on already tight budgets. The connection between insurance costs and disaster exposure is also becoming harder to ignore. Federal Reserve survey data found that about 2 in 10 adults reported being financially affected by a natural disaster during the previous year. At the national level, an OAS database recorded 403 weather and climate disasters causing at least $1 billion in damage between 1980 and 2024. For homeowners, those figures are not simply statistics. They help explain why insurance costs are becoming a larger household issue. As disaster-related losses continue and rebuilding costs rise, the financial effects can eventually work their way back into insurance markets and household budgets. This creates a difficult cycle. More losses can contribute to higher costs. Higher costs can increase premiums and other insurance-related expenses. Higher housing costs can squeeze savings and emergency reserves. And thinner financial reserves can leave households more vulnerable when the next problem arrives. Some homeowners have already reached a breaking point. According to the Federal Reserve's survey of household economics and decision-making, 7% of homeowners reported having no homeowners insurance coverage. Among those homeowners, 43% said affordability was the reason. That is a critical detail. This is not simply a story about consumer preference. For some households, insurance affordability has become a genuine financial challenge. At first glance, dropping coverage can appear to solve a budget problem. The monthly cost disappears. The annual bill gets smaller, the pressure eases, but the long-term risk changes dramatically. A paid-off home is not cost-free. And a home without insurance protection may leave a household exposed to losses that could threaten years of accumulated savings. This highlights one of the most common misunderstandings in homeownership. People often assume that a fixed mortgage means a fixed housing cost. It does not. Others assume that shopping around will always solve the problem. In some markets, availability may be shrinking, coverage may be changing, or deductibles may be increasing. Some assume the cheapest policy is automatically the best option. But a lower premium may come with trade-offs involving deductibles, exclusions, or coverage limits. Others believe deductibles matter only when disaster strikes. Yet that is precisely when deductibles matter most. The issue is not only whether coverage exists. The issue is whether coverage performs as expected when a household needs it. Another important reality is that insurance now occupies a larger share of the mortgage payment than many homeowners realize. According to ICE Mortgage Monitor, the average annual property insurance payment for mortgage borrowers was nearly $2,370 and represented 9.6% of principal, interest, taxes, and insurance costs. For many households, insurance is no longer a small supporting expense attached to homeownership. It is becoming a major line item, almost a second mortgage in terms of its effect on the family budget. This does not mean homeownership has stopped making financial sense. It does not mean insurance markets are collapsing everywhere, and it does not mean panic. What it does mean is that homeowners may need to think differently about affordability. The traditional calculation often focused on the mortgage. The emergent calculation includes insurance, deductibles, coverage quality, property taxes, maintenance, and the ability to absorb unexpected costs. The question is no longer only whether a household can afford the house. The question is whether it can afford the full cost of protecting the house. That distinction matters, because financial pressure rarely arrives all at once. For many households, it builds slowly, a higher insurance renewal here, an escrow adjustment there, a deductible increase that seems unimportant until a claim occurs. Individually, each change may appear manageable. Collectively, they can reshape the financial reality of homeownership. And that is why the home insurance story is ultimately much bigger than insurance itself. It is a story about financial resilience. It is a story about retirement security. It is a story about how rising costs can quietly reduce flexibility long before they create a visible crisis. The mortgage may still be fixed, but the true cost of owning a home is not. And for millions of middle-class Americans, recognizing that difference early be one of the most important financial lessons of the years ahead.